Tomy Shaw, and here today we'll be calculating how to determine the value of a property. We'll be using an Excel spreadsheet and we'll go through all the ratios and numbers that you need to know before investing in real estate. So don't forget, if you're new to my channel, don't forget to subscribe, to hit the notification bell. I'll be posting pretty much every day. So let's get started with finding out how to calculate the value of real estate. So I've already done a Excel spreadsheet and I tell you where to put the numbers to calculate the returns that investors want, the incubation rate in your city, the selling price that the seller is asking, how much you should pay according to the criteria that you're asking, the mortgage interest per year in percentage. So let's look at the first number that you need to determine. You need to determine how much money is it making per year. So in this example, I've put $35,000 and I've put 5%. If we change this number to 10%, it's gonna automatically change how much money is going to. This includes people that are not paying, the vacant apartments. It includes everything. Then we get to our gross operating income, $33,250. This is where a lot of people make mistakes. It's in their expenses, where we have insurance, manager, maintenance and repairs, transportation expenses, bookkeeping, postal expense, account and notary expense, utilities, telephone and internet expense, school taxes, municipal taxes. A lot of people forget to put, like in this example, my expenses for maintenance and repairs is 22% of the total revenues that it's making per year. And the insurance, not a lot of people make mistakes here because it's pretty simple. A lot of people forget to include the manager's 6.89%. That's with taxes included. And another thing that I see that they make mistakes is to forget to put all the other some of the other expenses because they want to make it look like it's a good deal. Don't do this mistake. Don't pretend to yourself it's a good deal when it's not a good deal. Be true with the numbers because this is not in your favor. When you forget to put the real expenses, you're gonna overpay for the property. So it's better to include more expensive, to put it a little bit higher, and to not forget to put your incubation rate, because your vacant rate, because this is going to increase the value of the property that you should pay. Let's just look, for example, I put 0%. This just made the price you should pay according to your criteria higher. Let's look. It's 234,000 and we put, so you just saved $11,000 by putting the right incubation rate. So it's really important not to manipulate the numbers. Let's say we put 0 here, okay? You just went from $220,000 to $337,000. This little mistake of $7,000 just cost you $110K. Don't make mistakes. I'm telling you, don't cut on these mistakes to try to manipulate the market and making it look like it's a better deal. So your operating income, this includes gross operating income minus all the expensive, which gives you an operating income. When we divide this number by the number that the seller is asking, this gives us a cap rate, or the return on the selling price, 7.26%. Your mortgage is, I've just put in $10,000 per year. This includes your passive, your equity, your interest payments and interest. So your debt cover ratio will be 1.45. What you do is you divide the operating income on your mortgage, and this gives you a ratio 1.45. This is excellent because the number that the banks are looking at mostly is that it has to be higher than 1.15. This means that for every $1.50 that comes in, you have $1 of payment and interest to pay. This gives you a good ability to be able to pay off your mortgage and interest and still have a positive cash flow. So what's left after your mortgage payment and interest is that this is your cash flow. How much money is really going in your pocket in 1 year? So in this example, it would be $4,510. Your return on investment, since we are using leverage, you are not paying the total amount, $200,000. You are paying $200,000, but you're borrowing $160,000, which means you only have $40,000 worth of equity, and you take this number, the operating income divided by your equity in the property. This gives you a 26.28% return per year, which is a lot higher than in stocks, because one thing you can't do, well, you can do, but it'd be really risky and suicidal, is that if you use leverage in stocks, you could increase your returns, but it's not something that a lot of people recommend because you're already in a sector that is highly risky. So you'll want to go 100% equity in stocks, while in real estate you use other people's money to make money. And let's look at the cash on cash returns, 11.28%. This means you have $4,510 on $40,000 of equity. You're making cash on cash returns of 11.28%. So if you like this information, don't forget to subscribe, don't forget to follow, don't forget to hit the notification bell. And if you want, I could leave maybe an Excel spreadsheet. If you send me your email, I could send you this Excel spreadsheet. You could manipulate the numbers. You could see, okay, what if I increase this number or something else. You could work out this example and make it like you, once you find a property, all you need to do is do this number. This works well for any property that is higher. And remember, all these numbers will be different, and don't forget to include all the expenses, because in every city it will be different. So that's it for today on Millionaire's Knowledge. Thank you. Have a nice day.